I need you to pay very close attention to what I'm about to show you, because what just happened in the silver market doesn't occur often. In fact, the last time we saw this exact technical setup, silver went on a run that caught almost everyone off guard. And I'm talking about the kind of move that turns modest positions into life-changing gains for those who recognized it early. Right now, as I'm recording this, silver's 50-day moving average just crossed above its 200-day moving average. Now, if you're not familiar with technical analysis, let me explain why this matters so much. This crossover, what traders call a golden cross, is one of the most reliable bullish signals in all of technical analysis. It tells us that short-term momentum has decisively shifted to the upside, and more importantly, it suggests that this isn't just a temporary spike. This is the beginning of a sustained trend. But here's what makes this particular moment so extraordinary. It's not just the golden cross. Silver's 20-day moving average is also perfectly aligned above the 50-day, which is above the 200-day. All three major moving averages are stacked in perfect bullish formation. The last time we saw this exact alignment was in early 2020, right before silver rocketed from $12 to $30 in just 8 months. Before that, 2010, just before silver's legendary run to $49. Let me show you exactly what's happening beneath the surface of this market, because the moving average alignment is just the visible symptom of something much bigger that's building. Silver closed yesterday at $32.47. That might not sound dramatic until you realize that price just broke through a resistance level that's been capping this market for 3 years. From 2021 through 2024, every time silver approached $32, it got smashed back down. Every single time. The selling pressure at that level was relentless. Banks, hedge funds, commercial traders, they all used that level as their line in the sand to short this market. But something changed 3 weeks ago. Silver didn't just touch $32, it blew through it like it wasn't even there. And here's the critical detail that most people are missing. After breaking through, silver pulled back to test that old resistance level, and it held as support. That's textbook technical analysis. Old resistance becomes new support. It's the market's way of confirming that the breakout is real, not just a false move. Now, with the moving averages aligned and that $32 level holding as support, we're looking at a setup that has professional traders salivating. Because they know what comes next in these situations. They've seen this movie before. Let me take you back to 2010 for a moment, because the parallels are striking. Back then, silver had been consolidating between $16 and $20 for nearly 2 years. Traders were bored. The metal seemed dead. Then in August 2010, the moving averages aligned just like they are now. The 50-day crossed the 200-day. All three averages stacked perfectly bullish. Silver was trading at $18. What happened next shocked even the bulls. Silver went vertical. By April 2011, it had hit $49. That's a 172% gain in 8 months. But here's what's important to understand. It wasn't the technical setup alone that drove that move. The technicals were just the trigger. What really powered that rally was a perfect storm of fundamental factors that had been building beneath the surface for years. And that's exactly what we're seeing right now. Let's talk about what's really driving this market, because the moving average alignment is telling us that big money is positioning for something significant. Start with the supply situation, because it's far more critical than most people realize. Global silver mine production peaked in 2016 at 900 million ounces. Since then, it's been declining. Last year, total mine production was 830 million ounces. That's a 70 million ounce drop from the peak. Meanwhile, industrial demand has been exploding. Solar panels alone consumed 200 million ounces last year, up from 100 million just 5 years ago. Electric vehicles, 5G infrastructure, medical applications. The list goes on. Total industrial demand hit 600 million ounces in 2024. Do the math. We're producing 830 million ounces and consuming 600 million in industrial applications alone. That doesn't even include investment demand or jewelry. The deficit is being filled by above-ground stockpiles. But here's the problem. Those stockpiles are running dry. The COMEX, the major exchange where silver futures trade, had 350 million ounces in registered inventory at the start of 2020. Today, it's down to 42 million ounces. That's an 88% decline. And it's not just the COMEX. The London Bullion Market Association reported that silver holdings in London vaults dropped by 200 million ounces over the past 3 years. Where did all that silver go? Into solar panels in China, into electric vehicle components, into industrial applications that consume the metal permanently. Unlike investment demand, where silver can come back to market, industrial consumption removes silver from the supply chain forever. Now here's where this gets really interesting. While physical silver is disappearing, something strange is happening in the paper market. Open interest on the COMEX, the number of futures contracts outstanding, just hit a 5-year low. That means the commercial banks that typically short silver to hedge their positions are backing away. They're not fighting this rally like they usually do. I've been watching the commitment of traders reports every week, and the shift is unmistakable. The big commercial traders, the ones who are usually massively short silver, have reduced their short positions by 60% over the past 6 months. These are the smart money players, the ones with inside information about physical supply and demand. When they stop shorting, it means they see something coming that makes them unwilling to stand in front of this market. At the same time, the managed money traders, the hedge funds and CTAs are just starting to build long positions. Their net long position is only at 30% of the level it reached during the 2020 rally. That means there's enormous room for momentum buying as this trend develops. When those algorithms start firing buy signals based on the moving average alignment, we could see a flood of capital into this market. But let's zoom out even further, because the technical and supply dynamics are playing out against a macro backdrop that's incredibly bullish for precious metals. Central banks around the world are trapped. They spent the past 2 years raising interest rates to fight inflation, and now they're realizing they've created a different problem. Government debt levels are unsustainable at these higher rates. The U.S. is paying over $1 trillion annually just in interest on the national debt. That's more than the defense budget. It's not sustainable. So what's the solution? They're going to cut rates and restart money printing. They have no choice. And when that happens, real assets like silver are going to explode. Because here's what most people don't understand about silver. It's not just an industrial metal. It's not just a precious metal. It's both. It has the supply constraints of an industrial commodity, combined with the monetary properties of gold. Think about what that means in an inflationary environment. Industrial demand keeps rising, regardless of the economic cycle, because solar and EVs aren't going away. But on top of that, investment demand surges as people look for inflation hedges. Silver gets hit with demand from both sides simultaneously. And we're already seeing the early signs of that investment demand returning. Silver ETF holdings bottomed in October and have been rising steadily since then. That's a leading indicator. When retail investors start buying silver ETFs, it's usually the beginning of a much larger move. Because retail is always late to the party. By the time they're buying, the smart money has already positioned, and the momentum is just starting to build. Now I want to pause here for a moment, because if you're sitting on $100,000 or more in retirement accounts, this is probably relevant to you. A lot of people don't realize you can actually hold physical silver and gold inside an IRA without taking a taxable distribution. I put together a free guide that walks through exactly how gold IRAs work, the tax advantages, how to roll over existing retirement funds, all of that. It's linked in the description if you want to check it out. No obligation, just information that might be useful given what's happening in these markets. All right, back to where this price is headed, because the technical setup is just the beginning of this story. Let's talk about the silver to gold ratio, because it's flashing a signal that's impossible to ignore. Right now, it takes 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. During precious metals bull markets, it often drops to 40 to 1 or lower. In 2011, it briefly touched 32 to 1. What does that mean in practical terms? If the ratio just reverts to its historical average of 60 to 1, and gold stays where it is around $2,650, silver would need to trade at $44. That's a 35% gain from current levels. But if we get a real bull market move, and the ratio drops to 40 to 1, we're looking at $66 silver. And if it reaches the 2011 extreme of 32 to 1, we're talking about $82 silver. Now, I'm not making predictions here. I'm just showing you the math based on historical relationships. But here's why this matters right now. The ratio has been stuck above 80 for 3 years. It's been one of the most persistent divergences in the precious metals market. Silver has been dramatically underperforming gold, despite having better fundamental drivers. That kind of divergence doesn't last forever. Eventually, it snaps back violently. And the moving average alignment we're seeing right now? That's often the technical signal that marks the beginning of that snapback. Let me give you a specific example of how this plays out, because I want you to understand the mechanics of what happens when silver really starts moving. In July 2020, silver was trading at $18. The moving averages had just aligned in bullish formation, similar to what we're seeing now. Over the next 6 weeks, silver rallied to $29. That's a 61% gain in 6 weeks, but here's what's fascinating. The move wasn't linear. Silver would rally $2 in a day, pull back 50 cents, then rally another $3. Each pullback brought in a new wave of buyers who thought they were getting a bargain. The momentum fed on itself. As silver broke through each resistance level, stop losses from short sellers got triggered, forcing them to buy back their positions. That buying pushed prices higher, which triggered more stops, which created more buying. It's a feedback loop that can run much further than anyone expects. And we're seeing the early stages of that same dynamic right now. Silver rallied from $29 to $34 in 3 weeks, pulled back to test $32, and now it's consolidating with the moving averages perfectly aligned. This is the setup. The next leg up is when things get really interesting. But let's talk about the elephant in the room, because there's one factor that could accelerate this move beyond anything we've seen before. And that's the growing disconnect between paper silver and physical silver. On the COMEX, roughly 150 ounces of paper silver trade for every ounce of physical silver that's actually available for delivery. Think about that. The price of silver is being set by a market where 99% of the participants are trading contracts that will never result in physical delivery. They're just speculating on price movements. But what happens when a significant number of those contract holders decide they want actual metal? We got a preview of this in 2021, during the Reddit silver squeeze. Retail investors started buying physical silver and taking delivery of COMEX contracts. Premiums on physical silver coins and bars exploded to $10 over spot. Dealers ran out of inventory. The U.S. Mint couldn't keep up with demand for silver eagles. The squeeze ultimately fizzled because retail investors lost interest and moved on to other things. But the vulnerability it exposed is still there. The paper market is still massively leveraged. The physical supply is still tight. And now we have institutional players starting to take notice. I'm hearing reports from dealers that large orders, we're talking 7-figure purchases, are taking weeks to fill. That never used to happen. When a wealthy individual or family office wants to buy $2 million worth of physical silver, dealers used to be able to source that in days. Now it's taking 3 to 4 weeks. That tells you something about the underlying physical market that the paper price isn't reflecting yet. And here's where this gets really interesting from a technical perspective. When physical premiums start rising significantly above the paper price, it creates an arbitrage opportunity. Traders can buy COMEX futures, take delivery of physical metal, and sell it at a premium in the physical market. That arbitrage buying puts upward pressure on the futures price, which then attracts momentum traders, which creates the feedback loop I mentioned earlier. We're not quite at that point yet, but we're getting close. Physical premiums are starting to tick up, delivery times are extending, and the moving average alignment is telling us that the technical trend has shifted decisively bullish. All the pieces are falling into place. Now, let me show you what the chart is telling us about where this could go in the near term, because the technical picture is remarkably clear right now. Silver has strong support at $32, which is the old resistance level that just flipped to support. Below that, the 50-day moving average is at $30.50, and the 200-day is at $28.80. So we have a staircase of support levels that should catch any pullbacks. On the upside, the next major resistance is at $35, which was the high from the 2020 rally. If silver breaks through $35, there's very little resistance until $40. And above $40, we're in blue sky territory. There's no meaningful resistance until the 2011 high at $49. What does that mean for risk-reward? If you're buying silver at $32 with support at $30, you're risking $2 to the downside. But if this breaks through $35 and runs to $40, you're making $8. That's a 4-to-1 risk-reward ratio. And if it really gets going and challenges the 2011 high, you're looking at a 17-point gain against a 2-point risk. Those are the kind of setups that professional traders dream about. But here's what I want you to understand about how these moves actually unfold, because it's not just about the destination. It's about the journey and how to position yourself to capture the maximum gain. When silver really starts moving, it doesn't go up in a straight line. It moves in waves. You'll get a sharp rally that takes silver up $3 or $4 in a few days. Then it consolidates for a week or two, frustrating everyone who bought at the top of the move. Then it rallies again, even harder than before. Each wave brings in a new group of buyers who missed the previous move and are desperate not to miss this one. The key is to position yourself before the first wave, which is right now. Because once silver breaks through $35 and the mainstream financial media starts covering it, you're going to see a flood of capital come into this market. Retail investors who haven't thought about silver in years are suddenly going to remember that it exists. Financial advisors are going to start recommending it to clients. Momentum algorithms are going to trigger buy signals. And here's the thing about silver that makes it different from almost any other market. The available supply for investment is tiny compared to the amount of capital that could potentially flow in. The entire global silver market, including industrial use, is only about $30 billion annually. Compare that to the gold market at $200 billion, or the stock market at $40 trillion. Silver is a rounding error. What that means is that even a small shift in investor allocation can move the price dramatically. If just 1% of stock market money decided to move into silver, we're talking about $400 billion trying to squeeze into a $30 billion market. The price would go absolutely parabolic. Now, I'm not saying that's going to happen tomorrow, but I am saying that the technical setup we're seeing right now, with the moving averages perfectly aligned, is often the early warning signal that precedes those kinds of moves. It's the market's way of telling us that something significant is beginning. Let me give you another historical example, because I want you to see the pattern that keeps repeating in this market. In 2008, during the financial crisis, silver crashed from $20 to $9. Everyone thought it was dead. The moving averages were in complete disarray, with the 50-day below the 200-day, signaling a bear market. But then in September 2010, the 50-day crossed above the 200-day. The golden cross appeared. Silver was trading at $18. What happened next was one of the most spectacular rallies in commodity history. Silver went from $18 to $49 in 8 months. But here's what's important. The rally didn't start immediately after the golden cross. Silver consolidated for 6 weeks after the crossover, frustrating early buyers. It chopped around between $18 and $22, going nowhere. A lot of traders gave up and sold. Then in November, silver broke through $22 and never looked back. It rallied $27 in 4 months. The people who sold during the consolidation phase watched in agony as silver went vertical without them. We're in that consolidation phase right now. The moving averages just aligned. Silver broke through $32 and is now consolidating between $32 and $34. This is the frustration phase, where weak hands get shaken out. But if history is any guide, the real move is just beginning. And there's one more factor I haven't mentioned yet that could be the catalyst for the next leg up. China. China is the world's largest consumer of silver, using over 200 million ounces annually for solar panels, electronics, and industrial applications. But here's what's interesting. Chinese imports of silver have been surging. In the first quarter of this year, China imported 45 million ounces of silver, up 30% from the same period last year. Why does that matter? Because China doesn't just import silver for immediate industrial use. They're stockpiling. The Chinese government has been very clear about their strategic goals. They want to reduce dependence on the US dollar. They want to secure critical industrial materials. And they want to position themselves for the green energy transition. Silver checks all 3 boxes. It's a tangible asset that holds value outside the dollar system. It's essential for solar panels and electric vehicles. And supplies are tight. If China decides to accelerate their silver purchases, either for strategic reserves or to front-run the supply shortage they see coming, it could be the spark.